If you cash out your 401k early, you are not just losing 10%. That's the number everyone throws around. It's wrong, or, well, it's incomplete. And that gap between what people think they're going to lose and what actually hits their bank account, that's where people get blindsided. Here's the thing. Everybody's heard the 10% penalty line. Financial advisors say it, your HR department says it, random YouTube comments say it, and technically, yeah, that number's real, but if you've ever actually pulled money out of a 401k before 59 and a half, you know the check you get back does not match the math you did in your head. So what's going on there? Why does the actual number feel so much worse? Let's break down what's really happening, because there's three separate things stacking on top of each other, and almost nobody explains all three at once. First thing, the second you request that withdrawal, your plan is required by law to withhold 20% right off the top for federal taxes. Not 10, 20. This isn't a fee, it's not a penalty. It's basically the IRS saying, we're taking our cut now instead of waiting. So if you ask for $15,000, you don't get $15,000. You get roughly 12 grand hitting your account because 3,000 already gone before you even see it. Now here's where it gets worse. That 20% withholding isn't even your final tax bill, it's just a down payment. The real bill shows up later. So, second thing, if you're under 59 and a half and you don't qualify for an exception, the IRS tacks on a 10% penalty, but this one doesn't come out immediately. It shows up months later when you're filing your taxes the following year on a form called 5329. So you don't feel this hit right away, it sneaks up on you months later when you're already spent the money you had. And third, the entire withdrawal counts as regular income for that year, same as your paycheck, which means it can bump you into a higher tax bracket, and now other income you earned that year is getting taxed harder too. So let's do the real math. $15,000, 20% withheld right away, that's 3 grand gone instantly. Then next year, the 10% penalty, another $1,500 you owe, plus whatever your actual income tax rate ends up being on top of that 20% estimate. By the time it's all said and done, you could be looking at losing close to a third of that money, not because the penalty is 30%, it's still technically 10%, but because withholding plus penalty plus tax bracket creep adds up to something that feels a whole lot bigger than 10%. And look, that's just the money you can see. There's a second cost that barely gets talked about, and honestly, it's the more expensive one long term. Every dollar you pull out today isn't just today's dollar. It's every year of growth that dollar would have made for the next 20, 30 years. 15 rand pulled out at 35 years old, that could have been worth 60, 70, even 100 grand by the time you actually retire, depending how the market does. You're not just losing the withdrawal, you're losing the compounding. And if you're cashing out during a downturn, you're locking in a loss and missing the recovery. That's the double punch nobody warns you about. Okay, but here's the twist. The IRS actually has a list, a specific, defined list of situations where that 10% penalty just doesn't apply. Most people have no idea this list exists and they pay the penalty completely unnecessarily. There's the rule of 55. If you leave your job, quit, get laid off, whatever, during or after the year you turn 55, you can pull from that specific employer's 401k penalty-free. Key word, that specific employer. Not an old job, not an IRA you rolled it into, just the account tied to the job you just left. There's something called the 72T, substantially equal periodic payments. Basically, you commit to a structured withdrawal schedule for at least 5 years or until you hit 59 and a half, whichever's longer, and the penalty goes away. But mess with that schedule early, the IRS could hit you retroactively for everything. Divorce, if a court order requires you to split your 401k with an ex-spouse, that transfer is penalty-free too. Death, permanent disability, certain medical expenses that go past a threshold, even an IRS levy on the account itself, all penalty-exempt categories. Now here's the part that trips people up the most. Hardship withdrawals. People think hardship is some magic word that makes the penalty disappear. It doesn't work like that. A hardship withdrawal is something your employer's plan decides to offer, not something the IRS guarantees you. Some companies don't even allow it, period, no matter your situation. And even if you do qualify for a hardship withdrawal, that does not automatically mean the penalty is waived. You could get approved for the hardship and still owe the full 10%, plus the 20% withholding, plus regular income tax on top of that.
Hardship gets you access to the money. It doesn't get you out of the cost. So what should you actually do if you're staring down a real financial emergency and your 401k feels like the only option? Check if your plan allows a loan instead of a withdrawal. This is different. You're not taking the money out permanently. You're borrowing against your own balance and paying yourself back, usually straight out of your paycheck, with interest that goes right back into your own account. No 10% penalty, no income tax hit. As long as, and this is the catch, as long as you don't leave that job before it's paid off. Because if you do, that remaining balance can suddenly be treated as a full taxable withdrawal, penalty included. At the end of the day, here's what it comes down to. The penalty itself is 10%, not 30%. That 30% number floating around online is the combined effect of withholding plus penalty plus tax, not the penalty rate itself. But even at 10%, even if you qualify for every exception in the book, you're still giving up decades of growth you're never getting back. If you've got to touch it, touch as little as possible, check every exception first, and ask your plan about a loan before you ever call it a withdrawal. Your future self is the one who's going to feel this decision the longest. And look, if this breakdown just saved your future self from a massive financial blindside, do me a quick favor. Hit that like button so more people can see the real math. Subscribe to the channel for more honest, no-hype breakdowns on how to actually protect your money, and I'll see you in the next one.